Hello and welcome to the Devon Client Webinar. It's a special one here today. I'm your host, Greg Smith, Head of Retail here at Devon, joined today by Managing Director and Portfolio Manager Slade Robertson, along with Portfolio Manager Tama Willis. And it is truly great to have you along. Of course, we're going to be going through the earnings season review on both sides of the Tasman, and also how Slade and Tama are positioning their portfolios and how they see the outlook going forward. And of course, there has been a lot to digest. And on that note, we can't start the webinar, I think, without acknowledging the price action overnight. A lot of volatility in the US indices. Of course, we had that eagerly awaited CPI number, and that came in hotter than expected. Inflation did moderate at the headline level from 8.5% to 8.3% in August, but the markets had been looking for that to come down to around 8%, and that's what has caused investors some concern. We have, of course, seen fuel prices falling. We have seen that in the US. We've seen petrol prices and oil fall, as we have globally, but that's actually been offset by other factors, including rising prices for food. Now, even when you strip volatile energy and food prices out of the equation, we still saw a lot of upward pressure elsewhere, including the likes of shelter, and the core CPI actually rose on an annual basis. It came in higher than expected, but rose on an annual basis for the first time in 6 months. So look, the ambiguity continues in the data. So obviously there's a lot for investors to unpick, and a lot of noise. And of course, we have that key Fed meeting next week. So certainly that CPI number overnight has rattled a few cages, as it were. But we'll let Slade give his view on that during the course of his presentation. Just before handing over to Slade, just wanted to reflect on the performance of the Devon funds and the various strategies, and it has been very strong, not just on a relative basis, but also in absolute terms. There's been a lot of volatility, particularly in the first half of this year, and that's also, of course, continued more recently. And look, there's been a number of factors driving this. We talk about performance. It's also processes, and we have some great, very strong, robust processes here at Devon that have been in place for some time, and that's certainly shining through. But it's also about the people. There's been a lot of fluidity in the fund management industry in recent times, but the investment team here at Devon has been incredibly stable. You've got obviously Slade on the top left of the picture there, a founding member of Devon, and he's certainly led there in terms of the portfolios he manages. Also Chris Gaskin as well, who's also another founding member of Devon, and certainly some longevity there. Mark Brown, CIO, ex-ANZ, but has been with Devon now for over 5 years. He certainly had a big part to play in terms of the processes that we operate and leading the investment team. And Tama Willis as well. Tama he was telling me the other day that he's had his 10-year anniversary at Devon, and certainly the strategy that he looks after is done very well as well. Victoria Harris, obviously leading our sustainability strategies, and she is very much a key member of the team as well. So great experience across the team, and including in a couple of really strong analysts as well that we have in terms of Patrick Washer and Ben Jenkin. Team works really well together. Look, it is a pleasure to see them operating in the investment room each day and literally feeding off each other and working in so incredibly well, and ultimately, of course, being responsible for the funds that are managed and the monies that clients entrust us with. So yeah, we're really pleased with the stability in the team, the experience that is there that speaks for itself, and the robust processes that I mentioned that are in operation at Devon. And these are some of the factors that have contributed to a very strong period, and periods about performance. It's not just recently, it's over a multi-year time frame now. I will pass over to Slade. If you do have questions during the session, do feel free to ask them in the questions box there, or you can save them during the end. We do welcome any questions. We do welcome any feedback you have, and it's very much an interactive webinar. But without further ado, I will hand over to Slade to start the rest of the presentation.
Thanks very much, Greg, and thanks everybody for joining in today. But it is really a pleasure to be here with you. And you know, it's in many ways I'm really pleased that we saw the volatility before we started this presentation. It gives us something, you know, to really focus on, and I'll use it just to demonstrate some of the I guess my views as to what's going on out there at the moment. Look, one thing that we don't do a lot of at Devon is spend time across the majority of funds that we manage trying to forecast and guess where some of the key macro factors are moving. We don't spend a lot of time trying to guess where markets will go on a day-to-day basis. It's a little different for me though, because I look after the Alpha Fund, and there is a requirement for some degree of timing with respect to investments, to a different degree to some of the more index relative strategies. But look, it is something that I often get asked to talk to, so I'm really happy to give you some views as to how I see things playing out from here. You know, one of the things that's really happened over the last really since the GFC, and has been that we've seen quite a constant directional sense in the pricing of financial assets, and it's largely been up. And you know, we've had interruptions along the way with respect to different periods of monetary policy change with respect to the COVID situation, but largely, you know, you've had markets going in sort of in one direction, and you know, that has sponsored different sorts of factors which have been more relevant in markets, such as momentum. What I would say is I really do think those days are behind us. I think we are moving into an environment now where you're going to see, you know, a lot more volatility, and you know, that sounds like an easy thing to say given the price moves we saw overnight. But you know, we now operate in a market where there are just so many substantially important macro factors affecting the sentiment of investors and affecting the pricing of assets, and I think that's going to be, you know, the case for the foreseeable future. So look, you know, so I think that's that, but that's not an issue for me. You know, one of the realities of what we do here at Devon is that we are very bottom up and fundamental in what we in the way that we conduct ourselves from an investment process perspective, and what we are finding now is the opportunity set to deploy capital into really good quality businesses at discounted prices is happening with, you know, quite a bit of regularity. And what we're seeing is that the stock leadership in markets and the sector leadership in markets is changing quite rapidly. And so you know, if you have the ability to step away from the noise in a macro sense and to really focus on sort of the fundamentals at a sector level and a stock level, then you know, you should do pretty well. Hey, look, when I think about the world we are today, you know, the reality is, from an economic perspective, you know, things look quite challenged. And you know, Tama and I spend a lot of time working together, and you know, when we look at the globe and we think about the sort of the major different economic sort of sets, we sort of break it into three. So you've got in the US, you know, you've got a situation where economic growth is clearly slowing, and it's slowing as a consequence of monetary austerity. And you know, what we saw overnight with respect to the CPI number is again what central banks and what certainly the Fed with respect to the US is focused on. They're looking to deal with this, and we are seeing rates going up very rapidly. And I think, you know, just going into this meeting now, I think the expectation is that next week, when we see the monetary policy change again from Jerome Powell, that the expectation is now in between sort of 75 and 100 basis points of change. These are really big numbers. I have got a chart here on the left-hand side, and albeit it's a day or two out of date now, subsequent to what happened overnight, the theme is still very relevant. You know, what we've seen is we've seen inflation numbers pick up really rapidly to a point now where they have started to roll over, albeit, you know, the core number overnight was disappointingly higher than expected. But the reality is that inflation is coming down, and it's again happening at quite a rate. I was having a chat with Greg Smith this morning actually, and we were just talking back around sort of economic history and, you know, times in markets where you've seen inflation dominating investment thematic and investor sentiment. And if I go back to the 70s, for example, you know, that was a time where that was certainly the case, but it all happened in a very progressive and quite long dated fashion. Everything we're seeing here at the moment is very rapid, and this is giving cause to this volatility we're seeing in markets. And you know, and I know that it will be the cause of many phone calls that you'll take with clients today. But you know, what I'm encouraged by is the fact that we are seeing inflation coming back. The Fed will continue to respond to this, and there is a real sense in markets that the Fed lacks credibility. If you look at both Jerome Powell and the policy framework that the Fed is using currently, it hasn't been one evidenced by success necessarily in the past sort of 5 years or so. If I go back to 2018, they over-tightened then. 2021, they overstimulated. So there is, I think, reasonable justification for concern for investors around the way in which they administer policy. So they're going to go hard with it, and this is leading to some of the, I guess, some of the headline noise that you're seeing at the moment, and it's certainly giving sort of ammunition to the bears in the market currently. We want to think about other parts of the world. So you've got China. I think a lot of own goals being scored there around zero COVID policy. Europe's fascinating. This situation with respect to the energy crisis. So it starts with natural gas. It's morphing into a much wider crisis in that sense. It's very real. Tama pointed out to me a couple of weeks ago that pre the crisis in Ukraine, I think German households were spending 1.5% of disposable income on natural gas and electricity. They're now spending 11%. So it's an enormous tax on economic momentum in that part of the world, and something that we're super conscious about. So when we think about it from a fundamental perspective, though, the way that it manifests itself for us at Devon is in terms of earnings, and certainly at the moment, there is, I think, some real scope for earnings to come down around the world. We've just been through the US reporting season. Again, it was pretty good. There was no sense there that we were on the verge of an earnings collapse in that market, and I'll talk about New Zealand and Australia in a few moments as well, but quite a similar thematic there as well. So companies are doing a pretty good job in this sense, but the reality is we are likely to see earnings come under a bit of pressure. One thing that I'd also point out, which I think is really relevant, and I apologise if I'm bouncing around a little bit here, but is just, and again, it adds credibility to the concern that we are going into a difficult economic environment, is just the way in which the yield curves around the world are pricing now. So I see overnight the level of inversion which is occurring on the 10-year curve, which is the difference between the 2-year rate and the 10-year rate, has again blown out to about 33 basis points. Now, if I go back a few weeks ago, back at this sort of about 4 weeks ago, it was trading at around 40 basis points of differential there, and that's the highest level of inversion that we'd seen since around 1980. So this is not an economic environment which is without challenges, okay? And I think we all accept that. The big question though is whether or not the market has captured this in pricing. And and when I look at this. The other chart there on the right-hand side, it's a pretty simple analysis of valuations across markets, and you can see what it's doing is just comparing the current PE ratios that we're seeing in markets, and it's a few days old relative to where we were 3 months ago and earlier in the year, and you can see that lots of these ratios have come back. Now, this is symptomatic of a market which is aware that we have got challenges ahead of us. Some of the PE compression that we're seeing is commensurate with other quite serious bear market situations that we saw back in the 2008s. Not to the same degree, but again, this is not a market that is unaware of some of these issues. So I think that's quite a positive. I think when I look at where the equity market is positioned, there is still it's very crowded with shorts. Most commentators in the market that you hear from are still very bearish, and they point to all these macro factors, which, to be honest with you, are very difficult to call. But again, the market has positioned itself for a tough time. Now, where do I land in summary with all those factors? Look, the reality is, I think that over the next, given what we saw overnight, over the next 4 weeks or so, I suspect we're going to go through another announcement by the Fed. We are going to see a huge amount of focus on inflation again and just how sticky it is. Look, I suspect it's something, given that markets have bounced recently, I suspect it's something which will act as something of a headwind to markets over the short term. But I am really confident that when I look forward from this point, sort of 12 months hence, that we will see asset prices in the equity space higher than where they are today. And I think this is something you need to be really careful about, because these sorts of macro-driven markets tend to be associated with a huge amount of emotion, and you get it in the newspaper, on the TV. The brokers and the sell side get all panicked because they've all of a sudden become an expert on inflation and on central bank policy. The reality at the end of the day is that this environment now is going to work its way through. We're going to see central bank response. We're going to see a repricing of assets in the yield curves and the bond market and equities. But I do think that this is an opportunity now to buy good companies at the right price. We've been doing that the whole way through, and as Greg pointed out earlier on, that type of unemotional, pragmatic approach to investing tends to work pretty well in this environment. And I'm very much of that view that we will see equity markets sort of go through more volatility, but I think over the next 12 months will migrate higher. I'll just make a couple of calls around the earnings season that we're seeing in New Zealand and Australia. And look, Australia was interesting again, going into it. All sorts of concerns around some of the challenges that corporate Australia was facing, especially with respect to the cost side. So whether it be interest rates, whether it be raw materials, in terms of commodities, whether it be labour, access to labour and the cost of labour, there was a range of challenges that businesses are facing, as we are in this country as well. And but it was a pretty good reporting season actually in Australia, as it was in New Zealand. And I was really pleased with the way that most of our portfolio companies performed. And one way that we do get a sense of it is just looking at the degree of change that analysts in the market have made to the 12-month forward earnings expectations. And you can see, looking forward 12 months, there was a decline of around 0.6%. Now that's it's a negative, but it's a small negative, and it's absolutely consistent with the average that we normally see around this time. So I think on average it's around 70 basis points. So again, nothing there that gave us real concern. And I think what was evident from most of the discussions that we had was that you had good management teams were doing a good job. And they were behaving in a way which was in recognition of challenges on the demand side and challenges on the cost side, and margins were largely maintained across good businesses. So again, it's something which I really do stress to you when you're looking at making investments, and when we're looking at making investments for you and your clients. It is something that we spend a huge amount of time on, because when you go through these sort of difficult economic periods, it is the one thing that will save the investment and save the corporate health of those companies. It's interesting when I look forward into FY23 and FY24. If we include the commodity producers, the expectations for Australia is around sort of zero growth over both those time periods. Now that would normally be something that would give me a bit of concern, just because you haven't got that buffer to navigate any negative surprises that creep through. But the reality is, because again, investors don't want to invest into a market which is going backwards. But when we carve out the commodity producers, and perhaps Tama can talk to this, what we see with the industrials and the financials is that there is actually likely to be a positive earnings growth of around 9% rather through to FY23 in Australia, and around sort of 3 to 4% in FY24. So again, outside of the resource space, corporate Australia is actually looking okay. When I looked at the results that came through in the last reporting season, the standouts were in fact the financials. So both the banks and the insurance companies in particular, with respect to their leverage off a rising interest rate environment, was good. Dividends were down a bit, which was disappointing, but we saw that being offset by a lift of around $3 billion in aggregate in share buybacks. So that was all pretty positive. That wasn't I don't think evidence of a structural erosion in free cash flow. It was more just a cyclical response from companies that they have managed their way well through COVID, through the current environment. Balance sheets are in good health, and they're investing into the future. So I think that's really quite positive. Just really quickly here on New Zealand, again, it was actually better than expected. This chart here just shows you the way in which earnings expectations are changing as we go through these different time periods. You can see that in FY22, we sort of clawed our way back. You've got sort of positive earnings experience in a delta sense for FY23, still going back a little bit, but heading in the right direction. The reality is that New Zealand relative to Australia feels tougher. I think anyone that's jumped on a plane and gone across to Sydney or Melbourne recently and then comes back to Auckland will recognise that there is a different tempo in Australia than what we have here in New Zealand. You know, the Reserve Bank moved sooner than the RBA, and probably, you know, and so that again is reflected in, I think, some of the economic lines that we are seeing at the moment, and also some of the companies that we see that have sort of exposures across both markets. So things like your Woolworths, your James Hardie's, again, they made the observation that Australia is doing better in an operating sense than what we see in New Zealand. But, you know, that as a given, and let's take that for what it is. New Zealand in that reporting season was actually pretty good, and we actually saw modest upgrades coming through for FY23. So again, you know, no major challenges there, and it didn't feel as if, you know, we are on the precipice for those good businesses of an economic collapse. Pricing power was important. We saw that coming through with companies like Fletcher Building, EBOS. They did well. Those companies which announced capital returns, you know, again did pretty well during the period. So things like your A2 Milks, your Fletcher Buildings, that type of thing. So so all in all, it was a pretty solid season, and I think it gives us a good platform. And I'll hand over to Tama now to talk about, you know, how he's positioning the Tasman Fund in particular, and some of the companies we own. But I think, you know, the earnings season gives us a good platform to understand where companies are, which is really important right now, because you're going to see all sorts of pricing volatility in the next you know, week or so, and the chance to buy some of these good quality businesses with a view for making money over the next 6 to 12 months, I think has been enhanced. So I'm pretty excited about it, and you know, do enjoy investing in these sorts of environments.
Great, thanks, thanks Slade. Thanks everyone for joining today. I run the Trans-Tasman Fund here at Devon, and you know, I think Slade's given a good overview of the macro and the earnings picture in Australia and New Zealand. And I think you know, certainly when you look at the backward looking data out of reporting season, actually was very encouraging in Australia, and even in New Zealand was reasonably encouraging. And when we look forward, and I suppose given that volatility, you know, we are looking for to own good quality businesses that have pricing power, that can pass on the costs that are coming through. Because I think what we're seeing at the moment, as Slade mentioned, you know, margins in Australia held up very well, because most companies right now are passing through all the costs they have. Wage pressures in Australia were more muted relative to the US, but they are accelerating. So when you look at, we talked to a number of banks recently, National Australia Banks offered 5% to their staff with an extra week's holiday. So that's, you know, that's starting to be where the banks probably need to see. Now that's a 5 to 6% increase in their wage costs. So at the moment, Australia's running about 2.5%. So when we're looking at businesses, we need to be really sure that as those costs accelerate, they can either pass them on and manage their margins effectively. So that's something we spend a lot of time focusing on. With rising interest rates, we have limited exposure to companies with high levels of debt, because they'll be refinancing at higher rates. So that leads us to be more a large cap bias, a quality bias, with where there's valuation support. And if you look through the top positions, and I'll run through a number of them, you know, Contact Energy you'll know well, CSL, the largest Australian healthcare group, BHP, a very high quality resource name. China is stimulating, China is recovering at the margin, that's supporting commodity prices which have been beaten up recently. Spark, you'll all know well, ANZ, Auckland Airport, you know, National Australia Bank, so Telstra, very good quality businesses with a real angle on valuation. So we feel very good about the portfolio and where it's positioned. Contact Energy on the slide 9 was really one of the highlights of results season in terms of their forward trajectory on growth and earnings, and they guided to Tauhara, which is a geothermal project in Taupo, being on schedule, and they also announced a new expansion there, which added another period of more growth when you look into 2026. So Contact Energy is by nature of these geothermal expansions, and by the fact that it's removing the Genesis swaption related to Huntly, is moving more renewable. We'll hit above 90% renewables over time, and also so that improves its carbon profile, but also the mid-cycle earnings for the business will go from circa 500 odd million of EBITDA, 525, up towards 750 million EBITDA when these expansions and growth options are all come through. So that's encouraging. The other factor, a couple of other factors that are positive, is that the large increase in gas prices in Europe is creating a rush for renewable development, which is meaning that wind turbines and solar are very hard to get hold of, which is pushing out New Zealand's build in these areas, which is keeping wholesale power prices supported. The one thing we are focused on is the Tiwai aluminium smelter. Rio Tinto are in negotiations with Meridian. There is some regulatory risk around that, but we at this stage think it's manageable. On balance, we think it's high probability that contract will be renewed, which will give these businesses some certainty over the next 5 to 10 years as electrification continues. Also, if you look at some of the asset realizations, Infratil is a good example of that, where you've seen Longroad, which is a renewable player in the US, sell for a stake for 40 times EBITDA. Contact trades at 12, 13. So it's a really good value business with some really great growth options. We're also very excited about CSL, which is a high quality healthcare name. Collects blood plasma in the US predominantly, and then creates life-saving treatments for all sorts of serious ailments, serious medical issues like haemophilia, hospital treatments, kidneys, kidney transplants, a whole host of really important treatments. And during COVID, obviously collections, which is the left-hand chart, fell away very sharply as people didn't want to go into plasma collection centres. That is coming back very strongly now. And during recessions, people who give their blood are paid $60 to $80 a time. They're flocking to do that again. So that means that the raw material required to produce these treatments is ramping up again, and demand is showing no let-up, it's still running at 8 to 10% per annum. So during COVID, their margins were impacted. They should bounce back. The flu business, which is our number 2 player globally, is going very well, and they've recently made an acquisition which we're really positive on. So if you look at this business on our numbers, we think it can do almost 20% per annum earnings growth for the next 3 years. So regardless of the macro environment. So when you look at that business versus a business that's very economically sensitive, you would look at this, and we think the trajectory and the options here with that sort of earnings and cash flow growth is very positive, and we have a substantial overweight position across the portfolios in CSL. Cleanaway, I think this is just an example of a waste business that has contractually passed through on almost all inflationary pressures. Doesn't mean they can't have some operational issues, which they have had a couple recently, but Australian Municipal Waste Collector, one of the largest, has landfills, has recycling centres, and is building compostable waste plants, and also doing waste to energy over the next 5 years. So it's really part of this new circular economy the Australian economy is trying to create. And if you look at the labour side, they have pass-through on labour. They have pass-through on levies related to landfills. They have pass-throughs on fuel. So, and their growth is generally GDP plus, and also if they win new contracts. But they're also generating additional growth from areas like waste to energy, recycling plants, and removing waste from the Australian economy. So if you look at the chart on slide 11, you'll see that we forecast 10% EBITDA growth right from 22 through to 25 as they layer in all these different expansion projects, and as they're able to successfully pass through some of the all of these costs. So that's a business that we like, and we see a lot of optionality, but regardless of the macro environment, should perform very strongly. And I think just a little name here, Mineral Resources, which we have, I think Greg's written a lot about it in our morning note. We have done very well out of this name, given the strength in lithium markets. And simplistically, the lithium strength, I think it's probably even surprised us, but the global rollout of EVs and the energy uncertainty you've seen around the world has certainly accelerated the EV production, EV demand from consumers. Lithium has not been substituted at all in these lithium batteries. Therefore, there's a huge pull on lithium hydroxide, which is the battery grade material to go into these lithium batteries. Now, as a result of that, any company that can expand and Mineral Resources has some of the best quality lithium mines, hard rock mines, where they just dig up in Western Australia, dig up the 1% to 2% lithium ore and convert it into lithium spodumene. At the moment, they're producing their share around 600,000 tonnes of lithium spodumene, and the price is about $6,000 a tonne. So you can sort of see the numbers that are spitting out, $3.5 billion of revenue, and the margins are about 80% right now. So that's contributing an awful lot of cash flow, and the business has been re-rated as the pricings remain stable. Now, having been a commodities analyst for a long time, we all know that what goes up must come down at some point. But in the near to medium term, it looks like that resilience in pricing, because of that demand pull, the industry is going to need another year or 2 or 3 to bring enough supply on to meet demand, which just means we could have exceptionally strong cash flows, which is starting to be reflected in the valuation of these names. So, we have seen opportunities. That's one of them. I think we have also, when we look across the market, we have seen a number of opportunities emerge in recent months. But given the volatility, we are taking small positions in some of these new opportunities and looking to add into weakness. So we feel like the portfolio is well positioned for any volatility. We have some cash we can deploy into names we like if we see any weakness, and confident how we're looking going forward. Happy to take any questions.
Yeah, excellent. Thanks for that, Tama. Okay, so just going through a few questions here. We've got one from Alice on, given the concerns around the economy, what is Devon's view on the banks? You did mention.
Yeah, absolutely. So it's a very good question. So at the moment, in our discussions with the banks, there's a short-term positive and there's a short to medium term, depending on what you want to term medium term, but short to medium term risk. Now, the short-term positive is that interest rates are rising quickly. The banks are retaining a significant level of deposits, which are at very low rates. And so there is a margin benefit as they lift mortgage rates, and that is flowing through to earnings at the moment. So there looks to be upside risk to earnings over the next 6 to 12 months, certainly particularly the next 6 months. And then as we look forward, if we look at in Australia, for example, which apart from ANZ, which has a big New Zealand business, the others are slightly smaller in New Zealand, the real lift in mortgage rates, because there are a lot of fixed rates locked in, happens in about June next year. So that is when the risk starts to become more evident on, will there be a bad debt cycle in the Australian banks? So that is a risk when you look out 9 months, 9 to 12 months. At the moment, asset quality is exceptionally good. Businesses are in very good health. They have large cash positions and are investing. Consumer confidence is weak, but consumer balance sheets are still strong. So for that reason, we are slightly underweight the banks. We do own National Australia Bank and ANZ, but that risk further out around bad debts keeps us from being overweight. We have a larger position in the insurance sector, which are very correlated to rising rates. They do get a lot of margin income out of their balances, which has been. They don't have the bad debt risk. Obviously, they have weather risk, but they have reinsurance, and they've also lifted up their natural peril allowances quite materially to factor that. And you'll notice from your own insurance bills, but they're jacking them up another 10% this year in Australia, and they're already well on the way to putting those through. So that is there to offset claims inflation and other areas. So we're monitoring that risk around bad debts for the banks very closely. At this stage, they look manageable, and we still think some exposure to the sector is warranted.
Okay, cool. All right, we've got one from Brett here on saying GDP numbers are due on New Zealand. I think that might be tomorrow. Doesn't matter if New Zealand is in a recession or not. What's Devon's view? Who wants to take that one?
I suppose numbers where we're watching that, the numbers and where they come out. But I suppose what we're more focused on is really engaging with the companies which we have met over reporting season, understanding how they're positioned. We had for example, you look at a business like Freightways that is quite economically sensitive. You'd say that there must be a risk if we're in recession to that business, but you talk to them and they're putting up prices. They are NZ Post's delivery and execution and customer service is materially worse, so they're able to charge a premium. They've been passing on all their cost pressures. They have made an acquisition where there's real growth opportunity in Australia. Their Big Chill acquisition has also been going very strongly, and there are some unique opportunities for them in the mid-heavy parcel area to increase prices, which would really be quite a big tailwind to earnings in the next 2 or 3 years. So every company, whatever the headline in GDP is, it will be in a different position related to how their business is performing. So we feel confident that we're assessing each company on its merits, and the GDP number itself won't make a difference to how we're positioned.
Okay, oh, that's fantastic. There's one more here. It's actually, it's not really a question. It's just a comment from David. I've been a long-term investor in Alpha. Just like to say to Slade and the team, really happy with the performance, and long may it continue. So thanks very much for that comment, Dave. We love feedback like that. I think what we'll do there, we'll wrap up the webinar today. Thanks very much, Tama and Slade, for your time. Some fantastic insights there. If you have any questions, you can listen back to a recording of this webinar as well. We'll be sending that out, and we'll actually also be contacting just via email each attendee just to see if there's any feedback on future webinars and what you might like to see. If you'd like to get a hold of us, do free phone number 0800 944 049. Email inquiries at devonfunds.co.nz, or you can always email me as well,gsmith@devonfunds.co.nz, or maybe even pay us a visit. You can arrange that via email. We're 17th floor of the HSBC Tower here in Auckland. Love to have you along. But thanks so much for joining today and for your participation. Wish you a great rest of the day and a great rest of the week. Bye for now.